Welcome to the deep dive. You've probably seen gold prices doing some interesting things lately.
Yeah, pulling back from those crazy highs, but still, holding above $3,300.
Right. So, the big question for a lot of folks, I imagine, is what do you do with gold right now? How do you even think about it as an investment?
Exactly. And we've been digging into this, looking at a recent Yahoo Finance piece. It featured Michael Gedd.
Oh, yeah, from the lead lag report. He's sharp, really understands market moves, and investor psychology, too.
Totally. So our mission today really is to unpack his latest thinking on gold, because he was actually pretty bullish not that long
It
ago.
was, wasn't it? But now he's sounding more cautious, at least short term.
Right. So we want to explore why he shifted, but also see if, the longer-term argument for gold still makes sense according to him.
Okay, let's get into it. So, Ged mentioned that back in October 2023, he was positive on gold.
Uh-huh. Billish.
But recently, like in the last 3, 4 weeks, was his phrase, his tone changed, more negative.
Yeah. And what's really interesting is why. He talked about seeing maybe a manic fervor phase developing in gold,
Manic fervor, meaning.
meaning like this growing belief that the recent run-up just has to continue. Everyone gets convinced it's a one-way street.
Ah, okay. And that kind of widespread conviction, sometimes that's a warning sign, isn't it?
It can be. It sometimes signals that maybe the easy money has already been made. It's this pattern you see sometimes, right? Retail investors piling in just as things peak.
Yeah, you hear everyone at the barbecue talking about it, and you start to think, who's left to buy? So, okay, let's step back. One big reason people own gold is for diversification, right?
Absolutely.
Yeah.
Good touch on that. Gold is, well, it's one of the few things that often doesn't move in lockstep with stocks or bonds or
Right.
inflation, deflation, even the dollar sometimes. It marches to its own beat, kind of.
So traditionally, the big players, institutional money, they look at gold when they're worried about other stuff.
Exactly. When they start getting nervous about a cycle turn in risk-on assets, as they say, stocks looking shaky, they use gold to maybe smooth out the ride if other things fall.
But Ged's point now, he's seeing something different, a more retail interest this time.
Yeah, that seems to be his observation. He said, and I think he put it carefully, no disrespect to retail, but
But they often jump in a bit late.
that was his suggestion, that maybe this wave of retail enthusiasm is a sign that, well, the biggest part of the move might be over.
So if that's the case, what could actually cause gold to reverse? Ged had a specific idea, right, about liquidity.
Yes, this was his core argument for being more cautious right now. He's thinking gold could become a source of cash.
How so? Like people selling it?
Yeah. If the stock market keeps bouncing around, gets volatile, and you see more margin calls,
Ah, margin calls. When brokers demand more money because your investments have dropped.
exactly. If that happens, investors might need to raise cash fast. What do they sell? Ged brings up this behavioral finance thing.
Oh, the disposition effect. I remember reading about that.
Right. The tendency people have to sell their winners before they sell their losers.
It's weird, isn't it? You'd think you'd cut your losses, but people often sell what's actually done well for them, like cleaning out the good stuff from the closet first.
Precisely. And Gade's point is, right now, gold is one of the few things that's been a strong performer for many people. It's a winner.
So if margin calls hit because stocks are falling, people look at their portfolio, see gold is up.
And they sell the gold to cover the calls. It becomes the go-to source of liquidity.
Okay, wow. And if that happens, what are the ripple effects? Gade mentioned a few things.
Well, potentially it could mean even lower stock prices, obviously. It could mean wider credit spreads.
So the gap between safe bonds and riskier bonds gets bigger.
Yeah, more perceived risk. And maybe counterintuitively, he suggested treasuries might become the main risk-off asset again. The safe haven. He called it the Phoenix Rising.
The Phoenix rising, like U.S. government bonds rising from the ashes of everything else falling.
Kind of, yeah. In a real stress scenario, money might just flood back into treasuries for safety and liquidity, even if gold is also falling because it's being sold for cash.
So just to be clear, Ged isn't necessarily saying gold is entering some massive bear market.
No, not necessarily forecasting a crash in gold itself. It's more tactical. He's suggesting investors might want to maybe wait for a potential pullback caused by this selling pressure.
Because it might create a better entry point later.
Could be. He did mention that historically gold often does sell off with other assets during big risk-off events, but maybe with a bit of a lag.
Like it holds up for a bit, then gives way.
Something like that.
Yeah.
It's not immune, but it might be the last domino, so to speak.
Okay, so that's the short-term caution. But you mentioned he still sees a longer-term case.
Yeah, he does acknowledge that. Gold could still do well, potentially, especially if we were to enter, say, a really prolonged bear market in stocks.
And how does that connect?
Well, he talked about retail investors and that buy the dip mentality that's become so ingrained.
Right, buy every time the market drops a bit.
Exactly. Ged suggests that a sustained downturn, one where buying the dip just leads to more losses for a while, could seriously challenge that mindset. You might retrain people, as he put it.
Making them less eager to jump back into stocks, maybe more open to alternatives like gold over the long haul?
That seems to be the implication. If faith in equities get shaken long term, gold's appeal could grow.
Interesting. And he connected this to the broader market health too, didn't he? Mentioning moving averages.
He did. He noted that when he was speaking, something like 80% of stocks in the S&P 500 were trading below their 200-day moving average.
Which is generally seen as a negative technical sign, right? A sign of a weak underlying trend.
Correct. It often suggests the broader market health isn't great, even if the main index number doesn't look terrible yet.
And small caps, he was even less optimistic there.
Oh yeah, he basically said small cap stocks might be halfway through a lost decade, still only back to where they were in 2020 in nominal terms.
Ouch. And that doesn't even account for inflation cutting into the real value.
Not at all. So beneath the surface of the big indexes, there's quite a bit of weakness, according to him.
And this environment, below the 200-day, often leads to more volatility.
Yes, he talked about volatility clustering. You get these sharp moves down, then sharp bounces back up, whipsaws, he called them.
Making it really hard to trade or invest with confidence.
Exactly. Very choppy, difficult conditions. And he thinks this kind of environment, volatile and maybe trending down, could persist simply because valuations are stretched.
So it doesn't even need a specific catalyst like tariffs or something. The market's just vulnerable.
That's his view. It's like dry tinder, he said. Any little spark could set things off.
And he actually said a correction or crash could be good.
Yeah, kind of counterintuitive, but he framed it as potentially a good thing for long-term investors.
Because it creates chances to buy assets cheaper, to buy low.
Exactly. Shakes things up, resets valuations, creates opportunities if you have a long time horizon.
Okay, so let's try and summarize Ged's view here. Short term, he's cautious on gold. Not because the fundamentals are broken, but because it might get sold off for liquidity if stocks wobble.
Pretty much.
Yeah.
Profit-taking, margin calls. Gold's a likely candidate to be sold because it's been a winner.
But longer term, especially if we see a sustained downturn in stocks that shakes the buy the dip faith, gold could still shine.
That seems to be the other side of his argument, yes. A potential beneficiary of a longer, tougher market environment.
So really, understanding both sides of this, the short-term pressures versus the potential long-term role, that's key for anyone thinking about gold in their portfolio right now.
Absolutely. It gives you, our listener, a much richer picture for making your own decisions in these uncertain times.
Okay, good stuff. So here's a final thought to leave everyone with. Considering this dual nature of gold, Ged highlights the traditional safe haven versus this potential source of quick cash in a sell-off. What's the most surprising way that tension could play out in the markets in the next few months? Something maybe nobody's expecting.
That's a good one to ponder. How those two forces interact. Yeah.
Definitely something to watch. Thanks for taking the deep dive with us.